Hello, I'm Andy Davidson and I'm CEO of Nova Growth Capital. Time and time again, I talk with financial advisors and they tell me that while the tax benefits of SEIS are incredibly compelling, they're worried that the underlying assets are just too risky for their clients. So today, I'm going to make the argument that they're not too risky, or rather why it doesn't matter. Now, before we start, in case you're wondering whether I know what I'm talking about, I can tell you that over the last 10 years, Nova have enjoyed portfolio growth of 80% year on year, and that's from investing in SEIS qualifying companies. I'm sure you'll agree that that's pretty tremendous growth. So, to add some colour to my argument, I'm going to give you some insight into how we achieved that. So, I'm going to tell you a little bit about our view on startup life cycle and valuation, risk and risk mitigation, return on investment, and most importantly, portfolio size and diversity. We'll also have the now ubiquitous segment on COVID, where we talk about how maybe COVID-19 may impact on these types of investments. Nova operate an SEIS and an EIS fund, and we tend to invest very early, and there's a good reason for that, and it's all about value and risk. There are a number of different methodologies you can use to value early stage pre-revenue or pre-profit companies. The Berkus model is one that we find interesting, and it basically asks you to attribute value in $500,000 segments based on components of a business that are already or could quite readily or quite quickly be put in place. Now, all of these components that you're looking at with the Berkus model, they're all really about risk mitigation. Now, drilling into this a little bit, you'll hear the Nova team talking about 90% of technology startups failing to make it to year 3. And 80% of those companies fail for the same 5 reasons. Well, the 3 biggest reasons, they're actually 2 really. The first is, believe it or not, people build the wrong thing. So it means they're not really validated. There's market demand for the product or the business model they're trying to deliver. And reason 2 and 3 are having the wrong co-founders or hiring the same people. Now, early on, that's kind of basically the same thing. So our Nova co-foundry approach goes a long way to mitigating these risks. We use a lot of techniques from the lean movement to ensure that the premise of the business is sound, so that the product or the business model will be valued by a market of a significant size. And we also team build around the founders, so we augment the company's existing team with members of Nova's team. Now, we've got over 100 employees that are all seasoned individuals in the arena of startups, so they've got all the necessary skills. We've got software engineers, hardware engineers, lean practitioners, digital marketeers. And our team's been working together for years, and we've been through lots of startup experiences together. So what, I hear you say? Well, if you apply the Berkus approach to these companies that we initially back, if you add Nova's interventions in, so our knowledge of lean and business model validation, and also our ability to team build, you'd quickly get to the point where you were valuing the startup at $1 million pre-revenue, according to Berkus. Now, in almost every circumstance, we buy at £300,000 pre-money. So in terms of pricing, on the way into a deal, we're buying really, really well on behalf of your investors. Okay, so we're buying well, but investing early is still risky. So does this still stack up? So we're going to talk about this and look at it from 2 perspectives. The first is kind of at a micro level at a single deal, and then we'll go on and look at kind of a more macro level at how a portfolio performs. So if we take a single company, it fits our criteria. We make an initial investment at $300,000 pre-money, and over the next year, that business is likely to achieve 2 critical things. 1, it's going to build out a minimum viable product so it can start servicing users, and 2, it's going to build some kind of strategic sales relationship or channel partnership. Now, if both those things happen, if you go back to the Berkus valuation model, you're now looking at a business that is perhaps worth $2 million. Now, it's at this stage that our EIS fund will invest. And typically our EIS fund is investing at a pre-money of maybe 1.5 million. So we're still buying well from a Berkus valuation perspective. But the interesting thing is what's happened in the last year. The share price that our SEIS investors bought at has increased by a factor of 5, which is pretty compelling. Now, if we follow this example some more, during the next 12 months, the business will be trying to demonstrate growing recurring revenues. And if it can demonstrate that it's got growth and there's various metrics people are interested in, if it can demonstrate it's hitting those metrics, then you're probably going to get to kind of a Series A type investment round, which again could be EIS, but the business is probably valued 5 million pre-money at this point. And actually, if it's in a sexy sector like health or fintech, it could be even more. Now, at this point, our SEIS investors holding shares at perhaps a 20 times multiple on their existing investment. Now, again, if we follow the life cycle through, it could be in a few years' time, but these companies could exit 20, 30, 40 million pounds, even higher. Now, in this case, if you achieve a 30 million exit, then actually your SEIS investor has achieved 100 times return on investment on that one deal. And this is why we like SEIS, because it's that first year provides that 5 times multiple. And it really makes an incredible difference on exit. So I can hear you thinking, okay, Andy, this sounds too good to be true. This sounds great. How many of these have you actually had? Well, I can tell you that over the last 12 years, I've been involved with 6 companies that are at the tail end of this trajectory. But on the flip side of that, at Nova, we've been involved in 90 companies, and over half of those have failed. And this is why the portfolio spread is so important. It's the single biggest impact on return investment. You've got to maximize your investors' exposure to the potential of being in one of these really high yielding, 80 or 100 plus times return on investment opportunities. And I will talk a little bit about the tax relief now. If you think about it, if you've got an investor with £100,000 to invest, if you can get £1,000 into each of 100 companies, if 99 of those companies fail, but one of them delivers 100 times return, then taking that tax relief into account, they've probably put 50,000 of cash in real terms, and they're getting 170,000 back 6 or 7 years later, which is phenomenal, really. So expanding on portfolio size, it's massively important. As a financial advisor, you really need to be trying to buy the market, and that's almost you need to kind of look through the fund manager. That all the fund manager is doing really is allowing you access to the underlying class of assets. So you need to look at how many underlying investments each fund manager is giving you, and you should try and build a very large portfolio. Now at Nova, we endeavour to give people 30 different investments within every given year. So if you invest with us year on year for maybe 5 years, we're going to get you well above 100 companies. And unfortunately, at the moment, money with multiple managers means multiple forms, which I know is an inconvenience, but ultimately it's the right thing to do for your client. And that's why I'm pleased to see the development of platforms that allow investors to invest with multiple fund managers. So lastly, what about COVID and the implications of COVID? Well, it's not really going to have a big impact on these underlying companies. They're typically IP rich, they're high growth. For large swathes of their life cycle through to exit, they're not actually dependent on revenue to fund their costs. Most of these companies have got reasonably long cash flow runways built in. They don't need to furlough their staff. They're getting on with building their businesses. So, in terms of what we know in the here and now about COVID, it's not going to cause any of these earlier stage companies to fail, unless it has a big impact on investor sentiment. And I think it is having an impact on investor sentiment. I think we saw last year with Brexit, then the election, and then COVID. Fund managers have seen a downturn in the level of funds that they've been able to raise, but you know, the companies that we are deploying funds into, they're like non-correlated. You know, they're not impacted in the way that more established businesses are. So in summary, investing early can be risky, but at Nova we believe we can evidence to you that the rewards far outweigh the risks. As an advisor, you can mitigate this early stage risk by building a large portfolio of underlying investments. Nova will endeavour to deliver 30 different companies a year. And lastly, I'd like to say thanks. I'm Andy Davidson. Thank you for taking the time to listen to me today, and I hope you choose to invest with Nova Growth Capital in the very near future. Thank you.